Good morning, everyone, and welcome to the November edition of our Economic and Investment Update, and indeed our last of the current calendar year. My name is David Baker. I'm Chief Investment Officer here at Mazars. Thank you very much for choosing to spend your time with us this morning. I'm pleased to say I'm joined, as ever, we have put aside our differences over the Elgin Marbles, joined by George Lagarias, our Chief Economist from Athens. So we'll normal format. If you've been on these calls before, we'll talk for about 35 minutes and then hopefully leave a little bit of time for questions at the end. We've had a few questions pre-submitted, but I think we probably have some space to take some from the call itself. So if you do have a question, please do pop it in the Q&A tab as opposed to the chat tab, and we'll try and get to as many as possible towards the end. So without further ado, let's move on. Probably start with some good news. November thus far, with a couple of days of it left, has been a very positive month for markets. You know, the so-called Santa rally, this notion that historically October has always been a pretty disappointing month in terms of stock market returns, but then in November and following through into December tend to be much more positive. And there's no real rhyme or reason for why this has been the case, albeit when patterns become established, people take notice of them, and particularly algorithmic trading models take notice of them. And sometimes these things can be a self-fulfilling prophecy. So far, so good for that notion. Global stocks up at 9%, bonds up 4% since the start of November. And we've titled that chart Rate Expectations Usher in the Santa Rally because there has been probably a significant mood shift in markets over the last month or so when it comes to our dear friend interest rates and the interaction with inflation. And I remember when we did our January webinar, I said we're probably going to spend most of this year talking about those two things, inflation and interest rates, and generally monetary policy responded to try and control inflation. And thus that has been the case. And as I say, in the last month or so, this feeling that the US has paused, the UK has paused, and Europe has paused in terms of putting interest rates up, and that might actually be more than just a pause. It might just be the end of interest rate rises in this current cycle. And if you look at what in the US Fed officials are saying, you're starting to get a little bit more of a dovish tone from the speeches that they give. And indeed, this week, Christopher Waller, a federal governor and a voting member of the FOMC, said that it is feasible that if inflation continues to come down along the same lines as it has been in recent months, then you might even get a rate cut in April, May, June of next year. Worth bearing in mind that that's not nailed on. It's not consensus. And indeed, in the same week, another Fed governor, Michelle Bowman, said that they might have to increase rates further from where they are currently. So that's not done and dusted, but certainly the market, if you think about those two contrasting statements from people in similar offices, the market chooses to focus on the one that says we think we're done and we think we might have rate cuts next year, because there is definitely at the moment an optimism bias in markets. So where does that leave us for the entirety of 2023? You may recall at the back end of last year, it might have been the start of this year, we made an observation rather than a prediction, certainly not a promise, but we made an observation that generally speaking, after a poor year for markets, the following calendar year tends to be a much better one. And with the exception, as you can see on the chart there, of 2001 and 2002, after the tech bubble burst in 2000, that has generally been the case. And the average return over all years being 6.5% for a balanced portfolio, so 60% in equities, 40% in bonds, is 6.5%, whereas in a year following a poor year, that average has been 10.7%. And you can see on the far right-hand side, albeit we're not done and dusted with 2023, as we stand at the moment, we're pretty close to that average return that you get after a poor year. So, returns never come in a simple and linear fashion, and a lot of those returns have come in the last month. But nonetheless, for the calendar year, that is where we stand. So for investors, a much more positive year than we had last year. So we've mentioned interest rates, and I said that we would, and we would keep going on about it. We do that because it's absolutely relevant. This is what you can see in terms of what the expectations are for 2024. The dark blue lines being where we are at the moment in terms of the interest rates in the US, UK, Europe, and Japan, and the lighter blue lines being the expectations for where those rates will be at the end of next year. And you can see by and large, excluding Japan, which is a bit of an anomaly when it comes to monetary policy, you can see quite a significant fall between the current rates and the expectations at the end of next year. The gap in the UK much smaller because the UK's inflationary position isn't nearly as positive as it is in the US and the EU. We had some really good Spanish inflation data out this week, and indeed US inflation, the last read that we had on that, surprised on the downside, which was obviously very positive. So that's what markets think. They think that we are going to have rate cuts next year, and you can see on the bottom axis that's currently where they are saying April, September and June respectively we might see the first interest rate cut. However, if you look to the right hand side, and despite what Mr. Waller said earlier in the week about the possibility of rate cuts, we know that markets tend to be a little bit too optimistic when it comes to what's happening with interest rates, or at least they have been in the most recent cycle. So the dark blue lines on the right-hand side chart telling you what markets were predicting a year on, and the light blue lines showing you what actually happened a year on. And again, you can see that there is a gap between market expectations and reality, and the light blue lines are, earlier on in the year significantly higher than the dark blue lines. So we think markets are optimistic. We don't think they're necessarily wrong, but we think they're verging on the optimistic side of the argument when it comes to what will happen with interest rates. But I think it's fair to say that there isn't a huge expectation unless we get an unpredicted second wave of inflation, which may come about for a whole variety of reasons, geopolitical tensions, commodity prices, etc. But unless we get a serious wave of inflation, a second wave, then we don't think rates are going up. That having been said, rates are not high by historical standards, and we ought to remember that we've come out of a very extraordinary period of ultra low interest rates and loose monetary policy, and it would be unreasonable to expect us to go anywhere near those levels in the near future, all other things being equal. And certainly that's our view on what central banks would prefer. You want to have, if you are a central banker, the ability to cut rates and cut them significantly if you get serious economic stress in your particular geography. And therefore, unless there's real need to, you don't want to cut rates too much. So that's where interest rates are. Let's have a move on and have a look at bonds, because we've spoken for many years bonds being largely uninvestable because interest rates were so low, and therefore you were getting very little yield, and you were carrying this risk of interest rates rising and therefore bonds losing value in real terms. we're now definitely out of that period, and you can see that the dark blue line at the top there, which is high yield, or lending to companies which have lower levels of credit worthiness, but indeed the light blue line, which is what we call investment grade, so well capitalized and financially sound companies. Both of those lines have ticked up, and that's the yield you're being paid for lending to those companies. And certainly the high yield line, that yield of about 9% looks to be pretty attractive. Worth saying there that whenever you're looking at high yield, the coupons on that, you have to take into account the possibility that you're going to get some default on that debt because of the poor creditworthiness of some of those companies. And when you look at how many companies are defaulting, you're currently around 4%, which historically is not particularly high, but I think I'd be more worried about the trajectory of that line, and it's definitely moving upwards. And in previous instances of recessions and economic stress, you see that line getting up to about 8-10%, and certainly higher if you look at the global financial crisis. So the yield is attractive, but that shouldn't be taken in isolation as a reason to hold that asset class. And indeed, we continue to be a little underweight there. So that's bonds. What about equities? Well, it's worth just bearing in mind and remembering the big returns that we've had, particularly in the year 2022, the end of 2021. We had significant returns in the MSCI World representing global equities, even though, as we can all remember, not much was happening economically because we were all stuck at home because of COVID. But nonetheless, equities rallied quite considerably. And you can see why that is, or at least one theory as to why that is because of all the quantitative easing that was taking place up to that point off the back of the global financial crisis, and then significantly accelerated during COVID, money being released into the economy, not necessarily making its way into the real economy, but getting stuck in financial assets. So you can see from this chart a very significant correlation between combined central bank assets, which is the dark blue line, and the value of global equities, which is the light blue line. And notice the little gap that's opened up right now, where the value of equities is higher than the combined central bank assets. But also notice that dark blue line has been moving down for the last 18 months, 2 years, as central banks try to pull some of this liquidity that they've put into markets back and reducing their own balance sheets. So that is a drag on the potential returns for equities, and it's one that we pay very close attention to. We're not overly concerned about it, and the next chart will reveal why. Because central banks need to have reserves again to fight the sorts of issues that we come up against in an economy. You remember Silicon Valley Bank a few months ago ran into difficulty, as is a few other regional US banks, and therefore the Fed had to go and inject liquidity quite directly rather than more evenly across the economy as they were doing through quantitative easing. But nonetheless, they needed reserves to be able to do that. And that sort of light blue band that runs across the bottom of that chart shows you, a view of what is deemed to be ample reserves, i.e. between 8 to 10% of nominal GDP is what a central banker feels that they ought to have in order to be able to act if they need to. And we're quite close to that. And for that reason, we think that quantitative tightening might start to come to an end during the next calendar year. And that's why we're not too concerned about it when you consider that correlation between global equities and central bank reserves. So just to finish off from me, just before I pass to George, just a note on the autumn statement last week. Obviously a lot of fanfare about cutting national insurance by 2%. That quickly got overtaken in terms of the press comment by the fact that you still have a very significant element of fiscal drag in our economy, i.e. we're not moving the personal allowance up in line with inflation or indeed wage growth, and neither are we moving the bands in which people get taxed at 20, 40 and 45%. And the net result there is that more people are going to be caught by income tax, and indeed more people are going to be caught in higher rates of tax than they currently pay. And whether that's moving into 20%, moving into 40%, or indeed the greenish bars moving into 45%, we think that this is going to have a clear and obvious impact on UK consumers' pockets in terms of their real spending power. And George, I'm sure we'll touch on the UK economy at some point in his presentation. So let me leave that there, and I'll pass to George to take us through, I think, first what's happening generally in the global economy.
Thank you very much, David. Hi, I'm George Lagarius. I'm the chief economist at Mazars. Before we touch upon the global economy, first of all, I have to say apologies. I don't have any good marble jokes. There is something I want to touch upon, which David said, and expand a little bit more on it. The market was surprised yesterday, and that's because one of the most hawkish members of the Fed came out in favor of pausing rate cuts, of pausing rate hikes, and indeed talking about rate cuts in the near future. That was Christopher Waller, who has been a staunch advocate of rate hikes. Having said that, as David mentioned, there was a comment by his colleague who said, yeah, no, I think we could see more rate hikes in the future. Now, all this is not an accident, and it's not a cacophony. That's what I want to focus on. This is carefully orchestrated. The Fed can't move from a pause to a cut in a single day, even if they change their minds in a single day. Okay, same way as they cannot say, okay, we stopped the rate hike cycle, because inflation may yet happen, supply side shocks. The system is quite vulnerable to these right now. So the point is that it's very carefully orchestrated, and it's the Fed's way of maintaining their caveats. But people like David or myself, indeed, who have been Fed watching relentlessly for the past 20 odd years, we can sort of read now between the lines and say, okay, if a hawkish member turns more dovish, that is the Fed trying to tell us something. And what the Fed is trying to tell us is that it's probably done with rate hikes. And this is why the bond market in the last few days has been gaining a lot of ground. It's some of the best performance in bonds in November that we have seen since the global financial crisis, really. And we expected this to happen this year. Obviously, no one knows when in the year that happens, and no one knows. You can get the whole year's performance in a month, and that's pretty much what we're seeing right now. So keep your eye on that space, because bonds are a very big market. They don't make as much noise as equities, but they do tend to move the economy around. Now, going to the economy. A large part of why the Fed has slowed down is, in fact, because the global economy is slowing down. So, they can't keep hiking rates if they feel the economic activity doesn't support that. So the global economy is slowing down, and that's happening. That should have happened early this year. It's happening late because China reopened up its borders about a year ago abruptly. So that boosted growth early the beginning of the year. So what was supposed to happen early 2023 happens now late in 2023, but it is happening. Europe and the UK are barely growing. The US is doing slightly better, although we'll show why, because it's not quite a matter of competitiveness. Next slide, please. As a result, we're still seeing about 50% of economists are still seeing the possibility of a recession, especially in the UK, a little bit less so in the US, and a little bit less than that in the EU. Personally, I'm in the camp that the US is probably avoiding the recession. It's more likely than not now that it's going to avoid the recession. I'm not so sure about Europe just yet, and that includes the UK. Next slide, please. Now, meanwhile, what we have is inflation dropping. So it's not just growth slowing, but inflation dropping as well. Headline inflation, which is on the leftmost chart, is dropping, and finally at a pace that everybody's happy with. I know that the UK is slightly behind it. That's because it has a super tight labor market, but we never advocated that UK inflation wouldn't drop. We always maintained that this was going to happen with a lag, and that's in fact what is happening. It also has to do with the structure of the economy. Core inflation, inflation, if you exclude energy and food, is more sluggish to respond, especially in the UK, and that's because it's so much services based. So you see on the rightmost chart, you see wages in the UK, and these are sort of keeping the core inflation a little bit higher than other countries. So watch that space as well, because this is what keeps the UK lagging. It's that reliance, so much reliance on services. Next slide, please. Now, as David mentioned, I won't need to stay on that for very long. Markets are pricing in rate cuts to begin around May. I'm talking about the US because everybody takes their cue from the Fed. I'm completely with David on this. Markets tend to be over optimistic. There are arguments for and against. If something breaks because rates are still high, real rates, then and the real rates are climbing, if inflation is dropping and your top interest rates remain where they are, that means that real interest rates are climbing. So conditions are getting tighter. So you could see earlier than that if there's a financial accident, or later than that if the global geopolitical tensions flare up again and you have supply side inflation shocks. So take these projections with a bucket of salt, generally speaking. Next slide. Now, let's go back a little bit and talk about, because I think this is the most important slide. The UK, the US and the UK so far have managed to avoid the recession, and they're going towards a soft landing, but they're borrowing heavily to do it. And that is something we must remember. And they're borrowing at high rates. So they're borrowing to do this, and this is a problem because it sort of undermines future growth. So they're taking some of the growth in the future and saying, okay, let's bring it forward to avoid the deep recession, and let a future prime minister pay for that, or president pay for that debt. So keep that in mind, and keep in mind that the US is growing at roughly 2.5% per annum. The UK is close to zero. So the UK borrowing almost as much as the US in terms of debt to GDP is getting near zero growth. So think where that growth would have been without this sort of fiscal stimulus. Okay, so keep that in mind because that is an essential part of the equation. Next slide, please. In fact, what we see is the debt globally is piling up. Global debt to GDP is now 340%, which is, I know, considering that it was near 220% at the beginning of the century. 23 years later, that is now at 340%. And we reached a stage, I'd say, especially in the US, where you're just borrowing to cover your debt. And they can do this because they have the global reserve currency, but that is a dangerous tactic. Now, And it's really, by the way, on the right-hand side, it's really non-financial corporates, non-banks essentially, and governments that are doing a lot of the borrowing. It's not banks and definitely not consumers. Okay, so keep that in mind, because at the end of the day, that will mean that it's those companies and governments that will be asked to deleverage, and deleveraging on a government level is very, very painful. It's called austerity. Next slide. As you can see, especially in the US, interest payments are rising. They're paying roughly 4.5% of GDP, and GDP growth is less than 3%. So they're paying more than they grow to interest payments. Okay, that's why we've reached a stage now where these things are not sustainable for very long. And next slide, please. And although I said consumers are not borrowing, we are seeing some evidence, although it's not yet on the long-term data, that a lot of them, especially in the US, are now using the credit cards, and they're beginning to default on those credit cards as well. The right-hand side shows you the pace of the of delinquencies, and they're in the US, delinquencies have been rising at the fastest pace, probably since at least 1992. Okay, so they had the COVID money, they spent that, then they went digging in the credit cards with a 30% interest rate, and now they begin to default on that. So, we have governments that have borrowed as much as they can, and we have consumers that have borrowed as much as they can, and that explains the slowdown, and that explains why central banks are not keen to hike interest rates much longer. Next slide, please. Now, I will run you through quickly because we lost a little bit of time. Generally speaking, the other reason why we're seeing the slowdown in the global economy is deglobalization. Globalization was in essence a China story coming into the fold, a very big economy, and but had remained largely secluded until the 1990s, and then it sort of came into the fold. It doesn't, I don't mean to say that's secluded now, but definitely it's that inexorable pace of integration has stopped and gone somewhat in reverse. Next slide, please. A part of this is because China became more important than the US at some point around 2011 in terms of manufacturing. Now has a bigger manufacturing sector, which a few years later, next slide, please, caused American presidents to declare a trade war on China, and that trade wars tend to proliferate. So what you have now is especially the last 3 years, you have a very big increase of tariffs and barriers in goods and services. Okay, something we haven't seen in a very long time. And if growth was fostered by low inflation in China coming into the fold, the exact opposite is hurting growth. Now, the next slide. Actually, Jordan, can we skip the next slide altogether? Sorry about that. We don't have time. It had a very interesting animation about the how long global reserve currency can last, because what the US is in essence doing, it's using the dollar to keep borrowing. And the question is, how long will they last? The answer of that slide, they just don't have the time for the full animation, was a pretty long time. The Spanish dollar lasted for 300 years, and probably 100 years after the Spanish Empire had by and large diminished, not collapsed, but diminished. And the US is still very much the global power. So I wouldn't make any bets against dollar primacy anytime soon. Now, in this environment, the question is, where will yields go? Okay, because that's a question all clients have. Okay, they see an interest rate at the bank deposit or a national savings account of 5%, 6%, and they say, okay, should I take this? Should I take a yield of 4.5%, 5% for a gilt? The answer is, of course, it's after years of zero rates, this is attractive. Okay, having said that, the question is, if that yield is coming down, so is this a once in a generation opportunity and we're going back to zero, or is this something that's going to stick around? And the answer is that inflation is not as anchored as it used to be, and it will never be again because China, that's been disinflating everything, is not as integrated in the global value chain as it was a few years ago. And then there is the huge issue of debt. Okay, we're borrowing to keep making interest payments and so on and so forth. So without central banks, which is what they did a few years ago, buying lots of money from the market and in essence printing money and giving it to the government, that means that all other things being equal, yields should remain high. So there is a very big takeaway, and it's, if you're worrying about your savings and stuff, obviously, when there is a yield, you should consider it. No two questions asked, but there's no need to rush into the yield. The yield might well be there, 1% high, 1% lower. The yield might very well be there for a long time, bar a financial accident. But even if a financial accident does happen and that crashes yields down to 2%, 1%, what have you, with that amount of debt overhang that we have, and without central banks continuously printing money and giving it to the economy, yields would rise again. Okay, so I would not become anxious about the yield. I think that's the message I'm trying to convey. Next slide, please. Now, in terms of the economy, generally speaking, of course, the visibility is low. Okay, and we have two major wars, and anything can go south. And we have, as I said, a lot of debt, and are probably areas in the market that have been broken. So either we never find out they were broken because they didn't matter that much, or one of them causes an issue, and then we wonder where the next crisis is coming from, or everything might go well. That's the point. You simply don't know from where you are. You need to keep your ears open, but you don't know. So there are three main scenarios that we're looking at. One is the soft landing, which means that growth remains largely stagnant, inflation continues to come down, labor market remains strong, and rates are higher for longer. There is the recession, which means growth continues to slow down. You see lower inflation, which would lead to rate cuts in the summer of 2024. There is the stagflation. So stagflation means growth continues to lower, but there is an eruption in one of the war fronts and energy and food prices spike, and then the Fed is compelled to hike again to avert a third wave of inflation. So that's your stagflation, pretty much what we live now, but stagflation, incidents don't tend to last for very long. And then there's a dream scenario, which was, we had to consider it, of course, which means that we get strong growth, a strong labor market, and still we see rate cuts, because it can happen because rates are high enough. Okay, and maybe governments will want to stimulate economies, especially ahead of elections. Next slide, please. So got one more, and then we can open it up to Q&A. We're sort of finally moving to the critical part of this cycle. We spent 14 years on the in the left side of the cycle where central banks were loosening. 14 years. Then we went to inflation as of April 21. Central banks eventually tightened 6 months after that. The first thing we had was a financial recession. Now we're living through the economic slowdown. And we're finally arriving at the point where the economy is becoming more important than inflation. It's not there yet in the sense that we paused rate hikes. The economy is as important as inflation. What we really need to usher in the next bull market is for the economy to become more important than inflation, which means that we're going to see rate cuts and the stoppage of quantitative tightening, and these two pillars can support an equity bull market. Okay, without these, especially without quantitative tightening ending, we will not likely see a durable equity bull market. So to cap everything, final slide. the geoeconomic fragmentation, China moving away, and Russia and the Middle East and all these countries, moving away from the Pax Americana is likely to persist into the next year, and I would argue into a few years ahead. The global economy, as we said, is slowing down as a result of this geoeconomic fragmentation. Indebtedness is rising. We're borrowing to keep an even keel. Inflation is petering out, but on the supply side, we still need to be careful. Where we are today now, rates are projected to stay there, not rise for longer, which means there's no real need to chase the yield on the bond side. And on the equity side, the moment we see rate cuts is probably A, when we will see an equity bull market, and B, for those who have bought bonds, they will also see the capital appreciation because the yield will drop and the prices for bonds will rise. That's how it works. So, we're getting to a point in the cycle, and I want to end with this notion where personally I am unusually optimistic going forward. I wouldn't say buy everything or anything like that, but I do anticipate 2024 to be a much better year, at least than 2022. And especially around equities, we could see a very decent year, I think. And with that, I think we can open the floor to questions.
Super, thank you very much indeed, George. And when you talk about your optimism, you're talking there about your optimism for markets as opposed to your optimism for the economy. And it's important to bear in mind that there is a dislocation between those two things. Let's go then to questions, and let me start with this one for you, George, which is around currency movements, and the question is, why has the pound suddenly started to move against the dollar? So it's at 126 against the dollar, up 4 points in the last 3 weeks, according to the question, but that feels about right to me. The first thing I'll say before you come on to that is, obviously for a UK-based investor with a balanced portfolio and a significant amount of your equity exposure and bond exposure held overseas, this is why we hedge around half of the currency risk within those exposures, because currency risk is an added element to the returns that you receive. So for those investment managers who don't hedge currency risk, when you have an appreciating sterling, that can really dent your returns as a UK investor. But George, just on the why that is, I mean, we're back to our old friends, inflation and interest rates, aren't we?
Yes. So look, markets have begun to price in rate cuts in the US much faster than other pricing rate cuts in the United Kingdom. So they're saying markets, because the currency summation of various market bets and outcomes, that we're going to see rate cuts in May in the US and possibly around September, October-ish in the UK. So that was enough of a reason for this, for the currency to rise. It's really the interest rate differential.
Absolutely. Thank you, George. And then another question linked to interest rates, but from a slightly different angle, around commercial real estate. And this has been an area of the market when you talked earlier about, do we see some sort of financial accident? This is something that a lot of people have been focusing on. And the question is, if we expect yields to stay high, what do we expect for commercial real estate long term, which used to trade at a sensible spread to government bonds? I think what the question is getting at is, if you're investing in real estate in the same way as you're investing in equities, you expect a greater return from that asset because you're taking a little bit of risk, and therefore the implication is that the values on commercial real estate might need to fall in order for the yield on it to rise. And certainly we've seen a lot of commentary about commercial real estate because of the levels of debt it carries, but also because of the changing way that our economy operates, hybrid working, internet shopping, etc.
So commercial real estate. First of all, there is to start with the last part, there is the obvious. We're buying from Amazon much more than we're buying from Main Street. So that is one, and the trend is there, and it's relentless, and it's been there for some time. So that's number one. Number two, in a recent fund manager survey, most fund managers see commercial real estate as the key credit risk for the global economy. So if there's a credit event, they're saying it could come from commercial real estate. Now, as real estate investors know better than I do, you don't directly go from boom to crash. You go through this period where you have less liquidity. Okay. So, buyers don't meet sellers, and the point where prices begin to collapse is when sellers finally relent, and they come down to the buyer's offers. We're not there yet. And in fact, I would have to say that, look, the fact that we're seeing shallow slowdown, not a recession, but a soft landing, tells me that there is less of a likelihood that we're going to see a commercial real estate collapse. In terms of a crisis, you could see the market slowing down, definitely even more from where it is. You could see liquidity persist, but do I see a credit event that's going to affect globally or the UK commercial real estate market? It is a possibility. It's a 1 in 3 possibility, but 2 in 3 is not my main scenario.
Thank you, George. And just to be clear, within our own portfolios, we don't hold any commercial real estate, not necessarily because of a view on the asset class itself, but because of that illiquidity that George mentioned. We feel that if we want to have liquidity in the portfolio, we can't have assets which are fundamentally illiquid because you cannot trade an office block or a warehouse on a day-to-day basis. Let's try and squeeze maybe two more in, George. And one on the topic that I know that we in the team have been looking at around the US market, and do you think the US market may have problems given the elevated valuation status, in particular within the 7 biggest tech stocks? And we talk about this a lot in the team, don't we, about the fact that the US market has really led the way. But actually, if you take out those what have been termed now the Magnificent Seven stocks, everything else is pretty normal and boring and more akin to what we see in the UK and Europe. But there is this group of stocks that has done extremely well, not least because of the enthusiasm about the possibilities that arise from artificial intelligence.
So, let's talk about tech. Tesla used to trade at 1,200 price to earnings when the normal is 15, and it had years of underperformance. Famously, when I was a fund manager back in the Stone Age, I never invested in Tesla because I didn't see the profitability. So from a fundamental perspective, yes, you can argue that those tech stocks, especially if you see the growth and the earnings, might not give you those valuations that you buy, but stocks can keep rallying for a very long time, even and defying fundamentals. So I wouldn't be willing to completely separate the Magnificent Seven from the rest of the market. Having said that, the rest of the market is nicely valued. It's not fairly valued, slightly above fair, but it is nowhere near overvalued. So I'm not worried about a valuation collapse. It's a different way to see the growth stock, the uber growth stocks. And here I have to say something. There is certainly, I believe, a behavioral element into this. And the more AI comes into the conversation, the more I realize it. For most people, when they think of AI, they think of Skynet and Arnold Schwarzenegger coming to kill them. Our culture has been imbued with technological advancement. So remember, fund managers were 40s and 50s, most of them. In the back of their heads, there is something which is, very strong, that tech will continue to deliver better outcomes and a better life going forward. And, they might not be wrong. Look where we are today, what we can do with an iPhone, and think of Don't even think of life before the smartphone. Think of life with when you had iPhone 3, how different it was. Okay, so fundamentally, yes, I get the arguments, but ultimately there is a very big behavioral element built into this, and I think it's ingrained into this. So I wouldn't be one to go against the trend. The trend is your friend in these situations.
Thank you, George. Questions coming in a little bit more quickly than we're going to be able to have a chance to respond to all of them, but let me just squeeze in one more very quickly before I take a last one to you, George, which is about private equity and the concern that's been highlighted in some media outlets about valuations in private equity and the outlook for private equity in the face of higher financing costs. And the question is simply, does Mazars hold many/any such assets in the client portfolios? The simple answer to that is no. Similar reason to I gave on commercial real estate. There tends to be a lot of good stories around private equity for the retail investor, but we've seen numerous times these things not working out in the way that were anticipated, and indeed clients having their money stuck in something that is so illiquid that it actually never realizes a return. And just gets stuck as a line on a statement for our clients. So we have no private equity. Private equity, in my own opinion, is very good at providing good financial returns for the people who run private equity funds, and less so for the people whose money they use to do that. But let's get in one final question, which is about the twos tens, George. So the twos tens is essentially what we call the yield curve. So it's the difference in the yield you're getting paid for lending to the US government over 2 years compared to what you get when you lend them for 10 years. And traditionally, you would expect, because you are lending for a longer period of time, you want a greater rate of return than if you're lending for 2 years. And that is the normal yield curve. But we've had for some time now what we call the inverted yield curve, where you're paid more on 2-year loans than you are on 10-year loans. And that has generally been considered a very good predictor of recession, not necessarily immediately, but sometime after that curve inverts. And quite often, George, when it disinverts, that's when a recession would tend to occur. And you put a sort of 40% chance on a recession in the US, despite the fact that we've had this very significantly inverted yield curve and it having not yet disinverted.
So yes, but the way yield curves work, this isn't magic, right? The way it works is that the yield curve inverts because at the short end, which is where the rate hikes live, we see abrupt rate hikes. At the long end, where inflation, longer term expectations live, things tend to be more anchored. So you have your normal yield curve, low yield for the short term, high yield for the long term. Then the short term rates rise, and you see the yield curve inversion, and that means that there's liquidity drawn from the market. Okay, this is the mechanism by which a recession is eventually triggered. The difference, I think, and I could be completely wrong, but the difference between now and past recessions, don't quote me as saying this time is different, but there is a difference, is that we borrowed a lot of money to stave off recession. So this is the key element. Are we actually going, is the US and the UK, will they be able to stave off recession by borrowing a lot of money? I can't say for sure, but I know they're very actively trying to avoid the recession, or to the very least to keep everything very shallow. But we're doing it at the expense of future debt at high rates. Okay, so we're deferring the problem. We're kicking the problem further down the road. I wouldn't say to the long grass, because the outcome will be more imminent than that, but we're definitely kicking the can down the road. So when entering that argument between the yield curve and the recession, we need to think of the borrowing at the same time, because this changes the equation.
Absolutely. Thank you, George. And that was very evident from one of your slides showing the US having a 7% budget deficit, and the UK something not too dissimilar. That notion of borrowing today and we'll worry about it tomorrow is one that is well ingrained, certainly in governments in the Western world.
As a Greek, I can attest to that.
Well, yes. Excellent. We've run a little bit over, but I think we had some excellent questions, so thank you for those. That will be the end of our final webinar for this calendar year. So I know many of you join us on many, if not all, occasions. So thank you very much for choosing to do that. We hope you find it helpful. And if it's not too early in the year, let me wish you a merry and peaceful Christmas. Goodbye.